Okay, ratio analysis. We use this a lot in finance. Ratios are especially useful for us in finance because very often in finance we're looking at what do we get back for the investment that we put in. And a ratio is a great way to do that. And it just helps us both evaluate how a company's doing and make decisions about what it should do. So let's talk about how that works. One thing I mentioned first is that I've got this no rocket science symbol here because there's nothing difficult about ratio analysis. A ratio just means you're taking one number and dividing by another. And we all learned how to do that very early in grade school. So the mathematics here is not difficult. Um, and so it's not about remembering how to calculate these ratios. It's about understanding them and how to interpret them. That's what really makes the difference in the effectiveness of these ratios is how well you understand them and how well you interpret what they're telling you, not simply the mechanics of how to calculate it. Okay, I've got an example here of some ratios you're probably already familiar with. One is miles per gallon. For those of you from somewhere outside the United States where you don't use the imperial system, you probably use kilometers per liter of fuel used. And you take the miles that you traveled and you divide by the amount of fuel it took you to go those miles or kilometers, whatever measurement system you're using. And that gives you an idea of how efficient your car is. And it tells you a lot about what's happening with your automobile. Very simple ratio, but it gives you a lot of information. And one thing I'd like you to think about is you don't necessarily know exactly where to define good and bad for these things. A lot of times it depends on your application. If you're trying to be very cheap and you don't care about how much power you have or how fast you can go, then you want this to be as large as possible. However, if you own, I don't know, if you have a trucking company and you're carrying a lot of things around all the time that are heavy and you live in an area where there are a lot of mountains and you need a lot of power, well, then you probably just don't, well, not probably, you don't want to just go for the highest miles per gallon possible because that type of vehicle will not have enough power to do what you need to do. All right, so there's useful information here, but you need to know how to interpret it. All right, and we use ratios all the time in everyday life. You probably just don't think about them as a ratio. I mean, if you work somewhere and you get paid by the hour, your wage is a ratio, the dollars you make per hour worked. Obviously, you'd like that to be as high as possible, but that's just a ratio. Your GPA is just a ratio, right? It's a measurement of the quality of the grades that you have earned over time divided by the number of hours that you've taken at the university. And again, for the most part, the higher the better for that, right? So, okay, we use ratios for a lot of things that help us understand and value things, make judgments about things. It's important that you know both how to calculate them as well as how to interpret them. So we're going to talk about some ratios in finance. There's some very common ones that we use very often, and I'm going to walk you through some examples of those. We'll start with liquidity ratios and then talk about other ones as we go along. All right, now I want to mention a couple things here before we get started talking about ratios. The two main financial statements we use to calculate these ratios are the balance sheet and the income statement. And you need to realize that those are calculated, the process you go through to make those statements is different, right? Balance sheet is a snapshot. It shows you the value of a company's stuff, its assets and its liabilities. It shows you the value at a snapshot, a point in time. I think of it as the end of the year. Right, right before midnight on December 31st, bam, they publish the balance sheet. And it's good right at that point in time. But then the way I think about it is, okay, well, then the next day they open the shop, they make a sale, their cash changes, their assets change, it changes. Right, so the balance sheet is only good at a point in time. It's a snapshot. The income statement is different. The income statement is a summary of everything that happened in the time period between income statements. Again, I think about it as a year. Typically, these are published quarterly, but it's easiest to think about it for a year. If you look at the 2024 income statement for a company, it tells you all of the revenue, the total amount of revenues, the total amount of expenses, the total amount of income that they earned over that entire year. Right? So the balance sheet is a snapshot. The income statement is a summary, a total of everything that happened since the last income statement was published. Okay, now this is important in ratio analysis because with a balance sheet, with balance sheet items, we will usually use averages to calculate the ratio. So I've got an example here. If we have a balance sheet item, I've got total assets. So if we have a company and their total assets on the balance sheet at the end of year 1 was 1,000, and then at the end of year 2, their assets was 1,500. What we say is that, okay, well then on average over the year, we think their asset balance was about 1,250. Right now, obviously that's not a precise measurement of exactly what their average asset level was over the year, but it's just a nice way without getting too complicated that we can kind of say, okay, their assets went from 1,000 to 1,500 over the year. So we'll treat it as if during the year they averaged about 1,250 in assets during the year. All right. So for balance sheet items, we're going to take the average of the two most recent items that we have. All right. The two most recent years or quarters or months or whatever we're dealing with here. Typically it's going to be years, right? We're going to take the average from last year and the average from the end of this year. We're going to take the point from last year and the point from the end of this year and the average of those two. All right, now notice this is not necessary for items on the income statement. Since the income statement totals up everything that happened over the year, you don't have to take any averages there. So we're going to average balance sheet items. We're not going to adjust the income statement items. Okay, so there's an introduction. I'll talk about some liquidity ratios in the next video.